Phil Grande of philsgang.com.
You know why people listen to my show? Because I make it simple. When you talk about the stock market, they make it so complicated. I make it easy to understand. For the average investor, the Main Street investor, most of the time, these guys, like they're talking to each other. We talk directly to you and we listen to you.
Invest better with the sound advice of Phil Grande at philsgang.com. Good investing means understanding how the stock market works.
Hi, I'm Phil Grande at philsgang.com.
All right, got about 30 seconds. And 3, 2, 1. Go ahead.
We are at all-time record highs for, you ready for the list? Stocks, home prices, Bitcoin, gold, money supply, debt. Inflation is running probably 50% higher than at the core, rather, than what the Fed would prefer. And the Fed's going to start cutting interest rates. I can see the case that a lot of people are going to love this, right? And take out more debt and leverage, and there's going to be a huge party.
Unbelievable. Well, how they forget. Welcome to Phil's Gang. This is my Friday radio show and podcast. You know what's amazing is they seem to have a short memory. It was only when we have this, when Powell comes out, it's going to be September 18th. And most people forgot what happened last September 18th, when after 4 years we didn't have a rate cut. They turned around and cut rates by 0.5 point. And everyone thought, oh, that's great, because when you cut the Fed rate by 0.5 point, that means the 10-year Treasury, which dictates your home mortgage, your business loans, your interest on credit cards, what we pay on the interest on the national debt, it's all going to come just falling down, and we're going to have one big party. That's what they thought. But it didn't happen. Just the opposite happened. We had a huge rally, okay, in the bond yields. And the bond yields soared to the upside. So, and they went from about, I think it was about 2.3 here. I'll even give it to you here. I think I have them right here. I mean, it's just ridiculous. Let's see if I can just pull them out here. M2 is the money supply. I thought I had them right here. But the, okay, I thought I had them for you. But but the rates just took off. I mean, they just went straight up, and they never come down. We're still over 4%. So it didn't work. So why do they think we're going to be so lucky this time it's going to work? When the setup, and so what the setup's worse now than it was back then. So we just have to wait and see. Now, everyone is basing this entire stock market, the entire economy on just a handful of stocks. Let's just take NVIDIA for a minute. NVIDIA is nuts. Think about NVIDIA. 81% of its revenue comes from 6 customers. 6. Okay? And then more than 1/3 of its revenue comes from 2 customers. What, are you nuts? That's insane. That's like having a restaurant and you have 10 customers and, they're big eaters and you're making a lot of money off the 10. One gets a chicken bone caught in his throat. That's the end of your business. I mean, that's pretty, they have millions of customers, but I'm just making a point. The majority of their business, their income is from just a handful of customers, just like the stock market we're in is just from a handful of stocks. But it doesn't matter how bad the stock market gets or how bad the economy gets, because as long as they continue to do stock buybacks so they can keep masking how bad the earnings are, and that's what really irritates me, is they come out every quarter and they say, look at the robust earnings, look at the robust earnings, and they're not robust. They're really just so-so. But what they do with stock buybacks, they can take those earnings and the stock price and push them up without sales, which should be criminal, for God's sakes, when you think about it. If you're sitting there and you have, let's say your stock's at $20 and you have $1 million in sales. Now earnings are coming out. So what do? They buy some more of their own stock. They do stock buybacks just before the earnings. They can't do it at the earnings, but it's got to be before. So now what happens is their sales, or their stock goes from $20 to $40. Telling us how earnings are terrific, right? But wait a minute. Their sales aren't up. Their sales are still $1 million. The third quarter comes. We go from $40 a stock to $80. What are their sales increase? Oh, just the same, $1 million. Fourth quarter, $160 stock. So the stock went from 20 to 40 to 80 to 160 on the same revenues, $1 million. They never increased their revenues. That's what's bad about stock buybacks, and there's 6 million of those. So they've been using these stock. Every time I hear how terrific earnings are, it makes me sick to my stomach. You got to be nuts. They're not terrific. But the bottom line is, no matter how bad this market gets, and here they're telling us how, oh boy, look what's going on here. We haven't seen spreads this narrow in 30 years. That's terrific. That's good news. Really? Tight credit spreads are good news? Well, they're going to use it, pretend it's good news, highest in 30 years, because now when you get these tight spreads, all that means is if you have, let's take the 10-year Treasury yield, and then take another security, take the corporate bonds. You can either buy the 10-year Treasury yield or you can buy the corporate bonds. The corporate bonds are at, let's say you're at 4.5%, 6%, and 0.44, those are the high yields. 4.88, that's investment grade, but your 10-year Treasury right now is at 4.07. So what's happening is all these investors, they feel financially confident because we have these tight credit spreads. And so they're going to go now and they're going to buy, and they've been buying all these very, very high risk, high yield, 6.44% bonds, corporate bonds. And a lot of money is going there. You got to be out of your mind, but that's what they're doing. So, but the point is, what is going to happen when September 18th rolls around and we don't get, the yields don't go down? What happens if they reverse themselves? Well, the market's going to be in real trouble if that happens. But it really doesn't matter. See, it doesn't matter. It doesn't matter we got just a handful of stocks pushing the market. It doesn't matter our deficits are terrible. I mean, just think about it. It doesn't matter that we have a stock market with record concentration of you got just a handful of stocks everybody's buying. And you got record bad breath, record stock buybacks, earnings are terrible. And so, and even with all this going on, with record national debt, record deficits, record stock market, stock margin debt That's the only thing that's keeping the stock market up, and the stock buybacks. And then, of course, we have record increased money supply. We have record increased corporate debt. You couldn't have a worse. And we have business bankruptcies in the last 7 months surged to a historic 40%. And we got historic bankruptcy, personal bankruptcies surged 24%. And God, go through that list, makes you sick. I mean, we got record household debt, record home equity lines that are in default. We got record low savings, 2.3%. 2.3%. What are you, nuts? Savings, 2.3%? Are you crazy? That's insane. And then, of course, in delinquencies from car payments to subprime auto loans to credit cards to home mortgages, it just goes on and on. And the housing affordability gap, my God, people don't have the money to buy a home, for God's sakes. A $450,000 home, that's about average today. You got to have a $228,000 income. The average income is about $70,000. That means you've got a gap of about, affordability gap about 57%. But yet the market keeps going up and up and up. It doesn't matter. So it will keep going up as long as, again, we have enough people that will buy the same 4 or 5 stocks that have been driving this whole market and are willing to go and borrow money and keep borrowing money. And as long as they keep doing that, and as long as every quarter the corporations get all this cheap money to buy their own stock back, to mask their bad earnings, to push up their earnings, to push up their stocks with no revenues, remember. This game just keeps going on and on. So it's all going to come to a head, I think, all of this in September 18, 2025, just like it did September 18, 2024. I don't agree with all these people who are saying that we're going to have this, the 10-year Treasury yields going down. I mean, if you're talking about risk, think what people are doing right now. They think this economy is so strong that they're out there buying these investment-grade yields, okay, junk with 4.88% returns, and they're buying these high-yield, the most risky bonds you can buy. I mean, real garbage, 6.4, and people are going to get killed with those. They're just the highest risk you can get, and they're all jumping in and buying those bonds because of 6.4% interest rate. It's just not going to. It's just not. Something's got to blow up here somewhere. So again, we have a real problem. Okay, again with the stock market, the labor market. So if you take a look at this labor market today, what a joke. Okay, the unemployment rate, remember, shot up from the previous number. Nobody's talking about that much, are they? No. But again, we got this margin debt. Okay, I mean, the labor market is horrible. That's our biggest challenge, is job openings. And nobody wants to talk about it. Our job openings keep on going down. So, you know, we're at like 7, we went from 7.2 to 7.1. And when the job openings is the most important thing you can look at. That tells you you can take all these job numbers, don't even look at them. It's all garbage, it's all lies, they're all manipulated. But look at the job openings. And when those job openings keep going down and down and down, that's where the problem is. And that will collapse in on you. You've got to have a strong labor market. We got a terrible labor market, not strong. Because remember, a strong labor market, that influences all the decisions, all the economic policies that our Congress puts together. And also influences all the investment strategies of the biggest banks and the biggest hedge funds. And I mean, the labor market, if you got a lousy labor market, they're just going to keep doing more stock buybacks. I mean, just think about how crazy that is. You can keep pushing stocks up as high as you want without having to have sales. But nobody ever talks about that, do they? Now, how the hell how does job numbers ever get so screwed up? It all started with George Bush. Now, first, it's called the birth-death metric system. It really started back in France during the Revolution. But when G.W. Bush got into office with Greenspan, and under Greenspan was this guy that nobody knew about, Bernanke. And Bernanke came up and said, why don't we adopt, okay, the birth-death metric system? And this way here we can rig the job numbers. And that's how it all got started, is when G.W. Bush was in, and as of May of 2003, he was going to start his new campaign, his re-election campaign. And so Bernanke comes up and says, hey, I got an idea. We could really push the job numbers. So on May of 2003, when he made his announcement he's going to go for a second term, it's the same day they told the BLS they got to adopt the birth-death metric system. So fake. It's unbelievable. So fake. All right, I'll be right back. Join my gang, Phil's gang, so you can trade this market properly. It's free for 10 days. Phil, check it out, philsgang.com. All right, let's see what we got here.
We are at all-time record highs.
At St. Jude Children's Research Hospital, we're fighting against childhood cancer every day. At the heart of this battle are our donors.
Most of us want to make some type of difference in the lives of others. St. Jude does miraculous work.
The fact that no one has to pay, it's a place where everyone is treated as an equal.
Everybody is welcome here, and it doesn't matter your religion or what part of the world you're from, all that is taken away. It just gives you some hope.
It's just a nice feeling to put your energy into something that really does genuinely make a difference in a child's life.
There's just no greater gift. If we have the ability to help, then we have a responsibility to help.
Finding cures, saving children. St. Jude Children's Research Hospital. Find out how you can help at stjude.org.
What does it take to be a successful investor in the stock market? Developing your skills and learning from an expert like Phil Grande and philsgang.com.
It doesn't have to be hard or complicated to learn how to invest in stocks properly. It's like anything else. You're going to golf, or you're going to learn how to play tennis, ski. You need to be with someone, learn off of them, one-on-one. Now that can be really expensive, cost thousands of dollars. But I have a program that you can join for 10 days free.
Go to philsgang.com and sign up for a free 10-day trial. Phil Grande has developed tools to teach you how to invest in stocks properly. Not only when to buy stocks, but how to sell stocks short.
85% of people in the market lose money. Get out of that group by just joining Phil's gang.
Now you can learn to invest like a pro with a pro, Phil Grande. Take advantage of this special offer for a free 10-day trial at philsgang.com.
Try it. 10 days free.
That's philsgang.com.
philsgang.com. It has it. Wealth exploded for the top 1% and the 1/100th of 1%. Not everybody. That's a bold-faced lie. It has not happened.
Wealth has just absolutely exploded over just since 2019. The wealth of all of the Americans has gone up in just 5 years by $52 trillion.
That's not true. That's a bold-faced lie. No. The wealth has gone up by the top 1%, okay, or top 10%, sorry, top 10%, 7 times more than the balance of the 90%. That is not true at all. That's just a false statement. That's crazy. So the stock market has been in this big bubble. It's been with increased money supply, which is historic, $22 trillion in historic money supply. That's the money they print. They keep pumping into the banks keep pumping it to the companies, CEOs. The companies take the money, do stock buybacks. They don't invest any money into business investment, no new machinery, no IT. They keep on buying their own shares back because they get rich. Doesn't help the folks that work in the companies, doesn't help the company, only helps the guys at the top. But this idea that everybody's getting wealthy, no. This market is sitting on this thin thread, okay, this thin thread. So if you have, for example, we are the most, let me find the numbers here. Okay, so this is what's crazy right here when you look at this. So here we have the stock market, right, booming like never before. But we have, in the last 7 months, business bankruptcies up 40%. Now our national debt is historic. Our deficits are historic. And our stock margin debt at $1 trillion is historic. Now how about this one? The undisclosed bank losses, almost $600 billion. They haven't disclosed them. They're hiding them. We have that $22 trillion I told you about, increased money supply. That's what's been propping the market up. But corporate debt is insane. It's at $8 trillion. And when you look at the interest rates today, and when you go back and take a look at the Fed rates, it's insane. Where we came from and these Fed rates is just crazy. We were at, and going into 2020, 2021, into 2020, interest rates were at 0.08, at 0%. At 0%. And remember, we didn't have an interest rate hike for 4 years until 2024, September 18th. And then, as I just told you, the 10-year Treasury yield that everybody thought was going to go down went straight up. Now, the only reason why I didn't take the stock market down is because, again, you have all these people going in and buying these stocks, just a handful of them on the dip, and they keep, of course, you have the historic margin debt. So now this last quarter we just finished here, I mean, it's amazing, the record mortgage, auto, credit card delinquencies. I mean, they're up as high, we're breaking all records. Subprime autos delinquencies up 50%, 50%. Credit card delinquency, highest in 30 years. And then we had the home-related expenses. That's the one that gets you. Think about that. When you get your paycheck, they take your taxes out, what's left, you bring home. It used to be 30% of that was related to the expenses that run your household. Do you know now it's about 49%, almost 50% from 30%? You can't make it. Just like someone who's going to buy a home, right? An average median price home in the United States, $462,000. You got to pay a mortgage is what, 30? That's about a $3,600 a month mortgage. But you got to make an income of $125,000 to buy this $462,000 home. It's going to cost you $3,600 a month, and you got our median income is $70,000 against a median house of $462,000. That's just totally insane. That's crazy. So, as I said, the labor market is what's going to take this whole economy down. The labor market, because they've been lying about it, right? What our jobs have been. And because of what the past administration did between 2023 and 2024, a guy by the name of Bernstein, who's been with Biden since he was even when he was a senator, he rigged all the numbers with the BLS. And now what happened is, now they're not there anymore. All of a sudden it starts coming out because also we see our numbers at 260,000 a month. Then all of a sudden the numbers drop to 168,000 a month. Then our numbers dropped to 85,000 a month. Now then they dropped to 35,000 a month, and that's when Trump fired the gal at the BLS. But what good's that going to do? So And if you got a weak labor market, which we really do, what they're going to be doing is doing these economic policies as if our economy was strong. They're doing economic policies as if we got strong labor market. That's the problem. That's when things get really screwed up. Now the tariffs last week just started last Friday. Okay, everything is going to get hit at least 10 to 17%. That's going to be huge. That's a tax. That's going to be huge, and that's going to really hurt. I get tired of hearing, oh, no, don't worry about it. It's not going to hurt at all. It's going to hurt, okay? And so, as I said, we've had this most overvalued market in history, and we have margin debt like we never had before, and we're being supported with NVIDIA. That's holding up the whole market. And the consumer's struggling. His debt has increased $185 billion in the third quarter. Second quarter, $185 billion, and his debt's going up so much, he's got to keep taking money out of his savings. His savings at a historic 2.3%. And as I said, this wealth effect, okay, all this easy credit, and they're saying how, gee, everybody's doing well. No, here it is right here, 7 times. The top 10%, their income has gone up 7 times higher than the guy on Main Street. Debt has increased 5 times on the guy on Main Street, the working man. The working man. Debt's increased 5 times, but his income's going nowhere. The top 1% increased 7 times. Well, here it is, right here. The wealth of Main Street is only going up 2%. 2%. That was it. I'm sorry, 2 times. 2 times. And the wealth of the top 10%, okay, is going up 7 times. So this is everything bubble. I mean, just our GDP growth is getting worse, much worse. And we had, and nobody wants to tell the truth about that. We have, as I said, if you look at the affordability gap, I mean, that's really widening. Let's see what else I got here for you. So they're saying the consumer is super strong, right? You hear them saying how it is. Let's see, where was he? He's saying how the consumer, where's the one that we had here, the consumer? I don't think I have that one. Oh, here it is.
The consumer's in solid shape, and that spending is at a healthy level. It's not growing.
Yeah, this is what he was saying to Jackson, how strong the consumer is. Is he nuts? If he's so strong, yeah, his savings is at a historic low, 2.3%, and they've been taking parking space in our head that the consumer is so strong. Yet since 1970 to 2025, his wages have dropped 17%. Since 1970 to 2020, his wages are going down. Adjusted for inflation, it's a 39% drop. 39% drop. And I think it was from 2001 or 2002, adjusted for inflation, wages are down about, I think it was down about 18 or 20%, something like that. So no one's doing well with that, and we only, the amount of people that have mortgages under 30%, under 3% rather, is a very small percentage. Everybody thinks that, boy, everybody got these mortgages 3% or lower. Very small percent. I'm trying to find it. I did all this for you really quickly today in between, but it was a very, very small percent. So the bottom line is that the consumer's struggling, the highest delinquency rate in 30 years between its credit cards and auto loans and mortgages.
It's 20%, though.
20%, thank you. 20% of all the mortgages in this country are 3% or less. That's it. So they always give you bigger numbers than that, but it's not true. And and the small and mid-cap businesses, bankruptcies are up 40%. There you go. Now, we got the hedge funds, remember, that are shorting the hedge funds are shorting the 10-year Treasury yield. So think about what's going to happen. They believe on September 18th this year, when they're going to make their announcement of their 25 basis point rate cut, they believe the 10-year Treasury yield is going to just drop. Going to just drop, okay? And it's going to be huge. No, it's not. It's going to go the other way. It's going to go up. So if you take, and if that happens, that's going to really shake this market up. I mean, just really big. And the institutional buyers, they're not in these tech stocks, by the way. They're not in these tech stocks. And as I said, the deficits is what's really killing us, because the deficits, remember, we keep spending more money than we take in, and we do it year after year. We just don't fix it. You got to fix it. They just keep spending so much more. It's crazy. And remember, the politicians love to spend more than they take in, deficits, because it makes it look to their community like something's happening. Makes it look like something's really happening. Oh, look, see the new ice skating rink? Oh, you see the airport? They expanded the airport. And that's all from money. And they go, look at the jobs we created. The politicians say, look at the jobs I created in my state. Look at, jobs increased 15%. Look at this. House incomes went up 15%. All this stuff. No, it's temporary. Because it's all a lie. It's all temporary. It's a deficit. If you did that with productivity, if we had productivity, where we had production, which were creating jobs, creating income, and people were getting wage increases, putting it back in the community, and then it just keeps rotating. That's not what's happening. It's all funny money. So the politicians are never going to cut deficits, because that's what gets them reelected. It just gets them reelected. So again, with their using deficits to spark an economy every time during elections or before elections, whatever. Think what happened last time they did it. The wages increased 17%.
1 minute.
Home values increased 45%. Jobs went up 10%. None of it from productivity. None of it from production. None of it from increased business investment. Usually when you increase your business investment, all of a sudden you get productivity. Now you start hiring workers, and the workers there already start getting wages. And then the other guys, more guys come in, they get wages, and then they get raises. And all of a sudden they're out spending in the community. And that creates more small jobs. And then you keep it rotating like that. That's how you build. Remember, this whole country is but built on small businesses. That's where the labor comes from. They talk about a strong labor market. It's not Apple. It comes from Main Street, the dry cleaner, the bakery. But we don't do that anymore. And to make the stock market look good, we'll just buy our own stock back. And the stock market always looks good. And then when the market starts to cave, what do? We do more margins. We borrow money to buy the same 5 stocks. So it's going to be interesting. You got to watch. Keep watching the jolt number. That jolt number keeps going down. That'll trip this whole economy, and then that's when you get your crash. All right. So I hope you liked some of that information we gave you. Join my gang. We'll help you in learning how to sell stocks, buy stocks, short stocks. Just go to philsgang.com, free for 10 days. We've been doing this for over 30 years, so we know what we're doing. We know how to teach trading. So check us out, philsgang.com, and I'll see you next Friday, same time, same place.